Hey, you guys, two questions that I keep getting over and over and over. Number one, are we in or are we headed to an economic recession? And are we headed for a real estate bubble or crash? I've been having a lot of conversations. I just got off the phone with a good client of mine. I've been diving through some stats and numbers. Listen, first thing you need to understand is that an economic recession and a real estate crash are not synonymous. And one of the things I'm starting to realize is that a lot of us lived through the last economic recession. And one of the things that's hard for us to dissect in our brains is that the last economic recession was directly indicative of a real estate crash, meaning that a real estate crash caused our last recession in a major way. However, when you look historically at the US economy, a recession and a real estate downturn are not always indicative of one another. As a matter of fact, there's been multiple recessions in US history where real estate prices didn't have a downturn at all. As a matter of fact, they continued to increase in value, or property values continue to increase during a recession. So that's the first thing you need to understand. Second thing you need to understand is if we look at two of these things separately, there's indicators for both. So let's look at the economy as a whole. Are we headed towards an economic recession? I did a little bit of research. From what I can find, right now we are about 125 to 126 months between now and the last recession, right? So when a recession starts and a recession ends, or a recession ends and the next one starts, there's cycles. We can tell from US history, studying numbers. The largest gap that I've seen in the last 30 to 50 years is about 120 months. So the fact that we're right now at 125 or 126 months means, yeah, we're heading towards a recession. I don't think that's any big secret, to be honest. The economy's been really good for a long time. However, that doesn't mean that we're headed towards a recession in 2020 or anytime necessarily soon. But yeah, ultimately we are gonna head towards a recession. But let's look at the key indicators. So first and foremost, we have unemployment, we have job growth, we have wages, we have GDP, we have interest rates, and we have the yield curve. All of these are tickers and indicators of whether or not a recession is coming or looming or starting. Now, when we look at each one of these individually, what we're gonna see is pretty strong signs that we're doing okay. Unemployment is an all-time low. I believe unemployment ended in 2019 at about 3.6%. That's the lowest unemployment, or close to the lowest unemployment we've seen in US history. Interest rates are at 3.6% currently for a 30-year fixed mortgage. So interest rates are at an all-time low, unemployment's at an all-time low. We're still estimated to produce 1.6 million new jobs in 2020. So job growth is going to continue, although that's slower than expected per the last couple of years. It's still growth. So job growth is continuing to happen. The other thing that they're talking about is we're going to start to see real wage growth likely step up. In other words, it's a double-edged sword when you look at jobs. Are we creating jobs, right? But then also, what kind of pay are those jobs creating? Are they all minimum wage type jobs, or is there actual wage growth inside of the job growth? So when we look at all these economic indicators, we're looking pretty good. Unemployment is low, rates are still low, job growth is good, wage growth is happening. The yield curve is a whole nother conversation for another day, but ultimately, are we ready, or are we headed towards an economic recession? Yes, there will be a recession. There is one looming. Are we heading towards any time soon in 2020? Not likely. Now let's look at the real estate market specifically. The real estate market specifically has its own tickers, right? Even though we're reliant on the economy, the real estate market is primarily driven by two things, okay? The first thing that the real estate market is driven by is affordability, meaning that the market will slow or pick up dictated on affordability. And a lot of that has to do with, does the average price of a home in the US, is it still affordable if you're making the average income? Meaning, can people who are making an average wage still afford an average house? And outside of major metropolitan markets, and even though that's a lot of what the media tries to focus on, New York City, San Francisco, Los Angeles, Seattle, right? We hear a lot of news about major metropolitan areas, but when you look as a whole as a country, affordability is still fairly good. The average wage earner is still able to afford the average type home or close to. Now, personally, I think that affordability is starting to get pushed on fairly good. I think that it's starting to stretch a little bit. I mean, I think we're hitting that bubble of affordability, which will start to slow down the increase in home values, right? So home values, they're going to be restricted by the ability for people to afford them, right? So we're going to see a little bit of that. Although the other thing that the real estate market is primarily driven on is supply and demand, like any other market. When we look at supply and demand, ultimately, I think we can all agree we have a lot of demand for housing and we don't have the supply to keep up with it. When you look at multiple listing stats and when you look at stats across the nation, the listing inventory, the number of houses that are being listed at any given point in time, has been declining since about August of 2018. So we're seeing less and less homes on the market, which means we have a higher demand than supply, which ultimately is going to keep prices good and it's going to keep the market moving. So what does this mean if you're a buyer? What does this mean if you're a seller? What does this mean if you're an investor or a real estate broker? It means a couple of things. One is that house prices are going to stay solid. They're going to stay high. They're going to continue to increase. We're looking at probably about a 4%, 4.6% increase nationwide across 2020 is what they're predicting. You're going to see them start to slow a little bit, but you're going to see houses selling fast. If they're priced properly, and you're going to see some selling for top dollar. But what you're going to see is you're going to see a supply and demand ratio that's not going to be met up with. So let's talk a little bit about that really quick. Where does supply come from? Well, if we look at the supply, a lot of the supply comes from what we call the residential resale market, meaning not new construction homes. But when you're looking at people that are transacting, right, a lot of times they're selling their house and they're buying their house. Well, a lot of people in the last 2 to 5 years that have wanted to transact because prices have been affordable and because interest rates have been really low, a lot of those people who have wanted to transact have transacted, meaning if you're a homeowner who had a house that you wanted to sell and then buy, you've done that maybe. And now when we look at the averages, people tend to buy and sell on average about every 7 to 10 years. So a lot of those people that bought in the last 5, 3, 2 years are not ready to transact again, meaning that they got the house that they want, they got the rate that they want, they locked in a low interest rate on a 30-year fixed mortgage, and they don't want to sell. So now all of a sudden it puts the onus of supply onto the new construction market. And when we look at the new construction market, new construction product has not been able to keep up with demand, and that's for a couple of reasons. So the thing that I ask myself is that going to change? In other words, back in the boom, or back when we had the last economic real estate boom in the early 2000s, a lot of it was new construction based. We were building. But when we look at our current economic state, because our economy is strong, here's the thing. New construction is being thwarted a little bit or being slowed down because of the cost of development and because of the cost of build. Why is that? Well, land is expensive, meaning that the real estate market has done well over the last couple of years. So house prices have increased, but so has land prices. So land is more expensive. Labor has increased, right? So wages have gone up. Materials are more expensive. Lumber, petroleum, concrete, all of the things that we use to build have gone up. And then of course, building regulations have increased. So when you're looking at building regulations, they're trying to make things safer. They're trying to build things better. So all of a sudden you have this quadfecta of expensive land, expensive labor, expensive material, and then increased building standards and increased building regulation. Ultimately, all of those things mean that development and building aren't ramping up at a rapid pace anytime soon. So ultimately, the new construction supply is not likely to meet demand anytime soon. So what does this mean? Well, back to the original question. Are we looking at an economic recession? Yes, one's coming at some point. I don't see it happening in 2020, barring something major happening. And number two, is a real estate bubble happening? I don't think so. And I don't think so, A, because real estate bubbles are not necessarily indicative of economic recessions. I believe even if we go into an economic recession that you're still going to see real estate hold strong for a while, and it's because of those reasons I just stated. Supply cannot keep up with demand, affordability is still pretty good, and the cost to develop and build is at a high enough rate that you're not going to see development outpace supply for sometime soon. The other thing is you look at a few economic indicators of a crash, and you look at what causes a crash. And there's some other tickers that I won't go into full detail with now, but you look at things like ARMs, how many mortgages are on 3 or 5 year ARMs. You look at things like default levels. I mean, all that stuff is trackable. So our default rates right now are still very good. There's not a lot of people getting into 3, 5 year ARMs. Lending requirements are still fairly stringent. We're not giving 100% financing away like we used to, and people are being held to a standard. And we're also buffered by the fact that the real estate market has increased fairly steadily over the last few years. So most people are in a fairly decent equity position, meaning that even if we saw an economic recession and people were forced to, or some people were forced to sell who had over leveraged, the demand would be there to beat that supply up, and ultimately they're not necessarily in an upside down scenario where they're going to have to short sale or get foreclosed on, because their original purchase and their down payment plus what the market's done has put them in a pretty decent equity position. There's the real deal for today, guys. Economic recession and real estate bubble. Hope that helps. Go out and have some great conversations.